There's this feeling you get in January when the year-end statements arrive. You open the envelope, your portfolio is up 8%, 12%, maybe even 25% if you rode the S&P through 2024. You did everything right. You maxed the 401k. You rebalanced. You stayed disciplined through the volatility. And still, something feels wrong. Because your car insurance renewal came 2 weeks ago, up 22%. Your health insurance premium at work, up another 7% for 2025. You're buying the same groceries, driving the same routes, living in the same house. The number in your retirement account went up. The math says you're winning. But the cash in your checking account disappears faster than it used to. You weren't irrational to notice this. You weren't bad at math. What changed is that inflation stopped being one number. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. The Bureau of Labor Statistics will tell you inflation for 2024 was 2.9%. The S&P 500 returned 25%. Subtract inflation, you got a real return of about 22%. Congratulations, you beat inflation by a mile, except you didn't. Not where it matters. I started pulling data on this 6 months ago because my own retirement projections stopped making sense. The spreadsheet said I was ahead. My bank account said otherwise. Here's what I found. The CPI, the Consumer Price Index, that gives you that 2.9% number, is a weighted average. It includes everything from televisions to eggs to rent. Some things got cheaper in 2024. Televisions, used cars in some markets. Fish and seafood dropped 1.9%, but you're not retired on a diet of flat-screen TVS and salmon. You're retired or planning to be on healthcare, eye shelter, insurance, and food. And those didn't move at 2.9%. Healthcare spending grew 7.2% in 2024. Not healthcare inflation, total spending, the actual bills you pay. Shelter costs, that's rent and owner's equivalent rent, which is what the BLS estimates you'd pay to rent your own home if you didn't own it. Those grew 4.6% in 2024, down from 6.2% in 2023, but still 60% higher than the official CPI number. Car insurance went up 22 to 26%, depending on which data set you trust. That's not a typo. Double-digit increases for the third straight year. Food away from home, restaurants, takeout, up 4.1%. Food at home was only up 1.2%, which sounds reasonable until you remember it's compounding on top of an 11.4% increase in 2022. Prices didn't go back down. They just stopped climbing as fast. Your portfolio beat the index, but the index isn't what you're spending money on. There's a term for this that most people don't know exists. Personal inflation. It's the gap between what the government says inflation is and what your actual cost of living does. And for retirees, that gap has been measured. Goldman Sachs Asset Management tracked this from 2000 to 2023. They found that retirees' spending increased at 3.6% annually over that period. The CPI over the same window? 2.6%. That's a full percentage point gap. Every single year, it compounds. If you retired in 2000 with exactly enough money, and you planned around CPI inflation, you're now structurally short by about 27%. Not because you spent recklessly, because the prices of the things you actually buy went up faster than the prices of things in the basket. This isn't a conspiracy. It's just math and weighting. The CPI gives healthcare a weight of about 8.5%. That feels low when you're 65 and spending 15 or 20% of your income on premiums, co-pays, and prescriptions. The CPI gives shelter a weight of about 36%. But if you own your home outright, you're not paying rent. You're paying property taxes, maintenance, insurance, different line items, different inflation rates. The BLS tries to capture this with owner's equivalent rent, but it's a lagged, smoothed estimate. It doesn't reflect what you're actually writing checks for. And car insurance, the thing that just jumped 22%, gets a weight of about 2.7% in the CPI. If you're driving the same amount you always did, that 22% hurts a lot more than 2.7% of your budget. The weights are national averages. They're not your budget. And if your budget skews older, sicker, more insured, more housed, your personal inflation rate is structurally higher than the number they publish. This didn't start in 2024. It started in 2020, March 2020. The Fed drops rates to zero, quantitative easing restarts. Trillions in fiscal stimulus flood the economy. Supply chains collapse, demand stays high, prices start moving, but they don't move evenly. By mid-2021, used car prices are up 30%. Lumber goes parabolic. Shipping container costs go from $3,000 to $30,000. Those are supply shocks. They're loud, visible, and temporary. Used car prices peak in 2022 and then fall. Lumber crashes back down, shipping normalizes. The CPI captures all of that. It averages the spikes and the crashes. By 2024, the index shows 2.9%. Contained? Normal. But healthcare didn't spike and crash. It just climbed 7.2% in 2024. Similar in 2023. The drivers aren't supply chains, they're utilization. Wage growth for healthcare workers, drug prices, and the structural shift toward Medicare Advantage and ACA marketplace plans that redistributed who pays what. Shelter didn't spike and crash either. It climbed from 2021 through mid-2023, peaked around 8%, and has been slowly declining since. But it's still at 4.6% as of December 2024. The reason it stays high is a lag. Most people don't reset their rent every month. Leases are annual. Owner's equivalent rent is calculated by comparing rents today to rents 6 months ago. The BLS model suggests it takes nearly 2 years for contract rents to catch up to market rents. So, even though market rents stopped climbing in 2023, CPI, shelter inflation, stayed elevated through 2024 and is projected to stay above pre-pandemic levels into 2025. Car insurance is a different animal. The 22% increase in 2024 is the third year of sharp hikes. Insurers lost $33 billion in underwriting losses in 2022. They've been playing catch-up ever since. Claims got more expensive. Average cost per claim is now over $11,000, up 11% in 1 year. Cars got more expensive to repair because they're full of cameras, radar, LiDAR. A fender bender now means recalibrating a sensor array. Labour costs went up. Severe weather went up. Hail damage alone jumped from 9% of comprehensive claims in 2020 to almost 12% in 2023. All of that gets passed to you because that's how insurance works. The inflation that crashed was the inflation in goods you don't buy very often. The inflation that stayed high is the inflation in services you can't avoid. If you've been planning your retirement using the CPI, your math is wrong. Not catastrophically wrong, but structurally wrong. The 4% rule, the idea that you can withdraw 4% of your portfolio in year one, adjust for inflation every year after, and not run out of money for 30 years. That rule assumes inflation matches the CPI. If your actual inflation is 3.6% instead of 2.6%, your safe withdrawal rate isn't 4%. It's closer to 3.6%. That's a 10% haircut on your retirement income for the same portfolio size. Or to say it differently, if you thought you needed $1 million to retire, you actually need $1.1 million. And if you're 55 right now and plan to retire at 65, you just added another year, maybe 2 of work. This is why it feels like you're behind, even when the statements say you're ahead. Because the finish line moved. It didn't move because of policy failure. It moved because the basket of goods you're pricing your future against isn't the basket of goods you'll actually buy, and nobody tells you this up front. The retirement calculators online default to CPI. The Monte Carlo simulations your advisor runs default to CPI. Even the Social Security Administration's benefit projections adjust for CPI. But Social Security benefits are indexed to inflation. If actual retiree costs are running a point higher than CPI, your purchasing power declines 1% per year. Compounded over 20 years of retirement, that's an 18% haircut in real terms. You can't fix this by picking better stocks. This isn't about alpha. This is about the denominator. There's always someone who wins when the math shifts. In this case, it's institutions with pricing power in inelastic categories. Health insurers, hospital systems, pharmaceutical companies, they don't compete on price the way commodity goods do. You can't substitute your way out of a medical procedure. You can delay it, but eventually you pay. Same with car insurance. You legally have to have it in most states. If every insurer in your state raises rates 15 to 25%, you don't have a real alternative. You pay. Landlords in supply-constrained markets. If demand for housing stays strong and new construction can't keep up, rents stay elevated. Owner's equivalent rent follows. It's not gouging. It's just what happens when supply lags demand. And if you're a retiree on a fixed income or near fixed income, you're on the other side of every one of those transactions. You're not the one with pricing power. You're the one absorbing the repricing. The people who came out ahead in 2024 were the ones with assets that grew 25%. If your income is wage-based or fixed, you're not keeping up. If your income is asset-based and you stayed invested, you kept up with the market, but not with your costs. The hardest part is that you did everything you were supposed to do. You saved, you diversified, you didn't panic sell in March 2020, you rebalanced when stocks were up. You stayed disciplined, and the system rewarded you. Your account balance went up. But purchasing power is relative. It's not what you have. It's what you can buy with what you have. And if the cost of the life you're planning to live is rising faster than the returns you're earning on the average dollar, you're not getting ahead. You're treading water at a higher nominal balance. This is the cruelest kind of inflation. It's not the kind that breaks the system. It's the kind that quietly recalibrates expectations. You're not poorer in dollar terms. You're poorer in outcome terms. The retirement you thought you could afford at 65 now requires working until 67. The healthcare you thought Medicare would cover now requires a Medigap plan that costs $6,000 a year. The financial independence you thought you'd hit with 1.2 million now requires 1.4 million. The goalposts moved, and they moved silently. I'll keep tracking this. The gap between official inflation and retiree costs, the lag in shelter, the compounding of healthcare premiums, the categories where prices don't come back down. Because this isn't about one bad year. This is about structural drift. The advice didn't change. The math did. And if you're 50, 55, 60, and you're trying to figure out if you're on track, the number you're measuring against might be the wrong number. That's not your fault. It's just how the system reports. But once you see it, you can adjust for it. If that's useful, subscribe. I'll keep pulling the data.